There's been changes or proposed changes again to the mortgage market. Not last month. We got some new ones to talk about with Aussie Jurek, plus what's going on with the mortgage rates. But first, I've got this week's quote of the week. As I've mentioned on several occasions, I found the National Post Rex Murphy's coverage of the U.S. election to be head and shoulders above anyone else in the Canadian commentariat. He actually understood there were two candidates. He's one of the people who makes me go, gee, I wish I could write that well. In his post-election comment on the many absurdities of the campaign, and by the way, they were not only on the Trump side on that one, as the vast majority would have you believe, he offered the following, in quotes. Boasting about her expertise in the area and her unparalleled experience, Madonna promised to give oral sex to any man who voted for Hillary Clinton. The threat did not go unheeded. All over the country, men went into hiding and trembling with dread. Some went so far as to vote for Donald Trump as the only guaranteed prophylactic. In fact, post-election analysis determined that the prospect of a service visit from Madonna tied with a promise from actress Lena Dunham to leave the country if Hillary lost. They were major motivators for the self-respecting male Democrats to come out in support of Trump. As I say, I wish I could write like that. That's Rex Murphy. Let's move on to Dr. Michael Berry. So happy to have him with me. What a perfect time when you're seeing this kind of action in the markets, in the bond markets. He's the co-editor of Disruptive Discoveries Journal. Dr. Berry, thanks so much for finding time for us.
Great to be back, Mike. Great.
Can we just start with, I mean, this is a broad-based question, but let's start with just the market, especially in the bond side of things, reaction to Mr. Trump's victory.
The only word I can describe it is surprising. I mean, everybody, and I mean everybody, missed it. And, the night of the election, you'll probably recall gold, when it looked like it was going to be in question, gold went up to $38. And then by the time the next morning rolled around, gold was on its way down. The markets had decided, Trump's going to win. So, therefore, there's going to be a big fiscal deal, and interest rates are going to go up, and all these things changed literally. Now, I think this is a knee-jerk reaction to his presidency because we haven't even seen his advisors really, and how they will deal with the current situation. So, I find it very, very interesting. A seminal time in the history of this country. Clearly, the country rejected the status quo and went for someone that's promised a lot and is untested at this stage of the game.
Yeah, we were talking just a bit earlier with Michael Levy about that bond market change. I mean, we saw yields go up really throughout the world, including in Canada, but in the U.S. Led by the States. I mean, I think the implications of that are huge. I mean, why would you sit in Europe with potentially a 10-year bond at zip, and you can move into the States and a 10-year bond over 2.3% again? So just on that level alone, I see big shifts happening here.
Absolutely. The demand for the U.S. dollar is going to go stratospheric, and at least until we see the smoke clear on this, which will probably be for 6 months or a year. And you can see the reaction to gold and precious metals. And the markets believe that interest rates will go up. They believe that the Trump program will be put into play. And I've had a number of insurance people call me and say, gee, my clients are wondering what happened to my bond portfolio. So we have to recognize it has been a very long, very extended bull market in fixed income securities and bonds, and at least at present, that's over with.
Yeah, it's interesting in this regard, too. I mean, just to remind the audience is how many ramifications there are. I mean, we saw the Canadian dollar go down, as you say, with the U.S. dollar going up. The euro got killed. But here's another one, though. I don't see how pension funds who've got this fixed income, who most of the time have unfunded liabilities, they don't have enough money set aside to meet their requirements, man, they can't take a bond market loss on top of that. I mean, what the numbers estimated are $1 trillion lost in about 10 days, but the ones I think about is the pension fund crisis is only going to get worse if we now start having a debacle in the bond market.
Well, Mike, you're absolutely correct. And not only that, but remember, there's a refunding big government refunding that has to be in play here in the near future, and refunding at much higher rates is going to be very difficult for the federal government. So there are a lot of different implications that have not yet been factored in to the economic scenario. And so, it's anybody's guess right now what will happen. I presented at the Federal Reserve in September, and it looked at that point like the Fed was throwing up its hands. And I had a number of people say to me, well, what does it mean? And, at that time, neither of the candidates was addressing these issues that have now come to fore. They were accusing each other of all kinds of things. So now we have the reality of the bond market being what it is, the dollar being what it is, gold being $100 lower than what it was, and this all has to clear in the next few months, and we will see if a fiscal program will save the Federal Reserve.
Well, we had the Federal Reserve out there this week. Janet Yellen was talking about, again, keep at least talking the higher short-term rates, when she was saying that the probability or the circumstances are now very auspicious for a rate increase. What did you make of that, or where do you sit in terms of the Federal Reserve raising rates in December, and even past December? I mean, it's a quarter point they're talking, but something more substantial in the year to come.
Well, it will be against the wishes of the president-elect and his team of advisors, I'm sure, but it will happen now. Now, when I presented in September, the Fed was thinking about all kinds of things. They were thinking about negative interest rates. They were thinking about going away from cash. They were thinking about the so-called helicopter drop. They have been at least temporarily saved by the bell. In other words, they've been saved by this election result. They will step in, and this will be against President-elect Trump's and his team's wishes. And I think you'll see that Chairperson Yellen will probably serve out her term to January of 18, and then be replaced by a more conservative member of the academe at the Fed. We will see a 25% basis rate increase in the Fed funds rate. It won't mean much, I don't think. It will try to pull the economy in, which right now they don't want that to happen. So at least the new administration doesn't want that to happen. So it'll be very interesting to see how that plays out.
It's been fascinating. One of the things I've been talking about, or the way I've been talking about it, is that we've got a two-tiered economy. And I think it's that played out in this election to at least some degree, that, if you're a manufacturing worker, who's been there 20 years, you've got real problems with technological substitution by far, number one, and number two, international competition. Trump didn't talk about the technological side, but I'm just looking at that, and who benefited? Well, you've got this sort of digital economy that's also that seems to be doing pretty darn well, at least in some areas. I just don't see how the Federal Reserve can rescue any of that stuff. I mean, to me, they've been trying the same things for a number of years, so I got to believe that they're scratching their head at this point.
Well, as of September the 12th, when I presented there, they had just been to Jackson Hole, and the comments that came out of Jackson Hole by the Fed people were things like, well, maybe we'll try negative interest rates, maybe we'll start doing away with cash, somewhat like the Indians have just done. Yeah, absolutely right. The Keynesians that run the Fed have no more solutions, and I think probably that's actually one of the hidden facts as to why President-elect Trump won the thing, that people wanted a change. And they didn't see it in the administration, and they didn't see it in the Fed. The Fed had thrown up its hands. So, again, we are going to have a change now. We'll see if this new administration can actually implement it.
Well, one of the confusing things for people about Donald Trump is he doesn't fit easily into the economic box that is a Democrat or a Republican. I mean, he's sitting there saying, you haven't done enough government spending, you haven't done enough borrowing, and we're going to do that on infrastructure. What would you place? Let's say he goes through with that, but what likelihood of success would you place on that for sort of a significant economic recovery?
I think that it's unlikely that we'll have a significant economic recovery. Mike, we've been in slower growth now for 8 years. For 100 months, we've had all the indicators, leverage ratios and everything, telling us that, growth has not been stimulated by either the government or by the Federal Reserve, any of the things they've done, the interest rate lowers and so on, the zero interest rates. I think that we're going back to a period where we reverse globalization. I can't see how this administration is going to raise $1 trillion to do what it needs to do in terms of a fiscal program. I don't see where that comes from. I guess we print. If that's the case, we'll have inflation. I can't see it stimulating growth given the makeup of labor productivity today and all the electronics and the things that are coming into play against middle-class workers.
I'm talking with Dr. Michael Berry. I love it because for many reasons, but one is that he has talked regularly to the Federal Reserve, just talked to them in September. Really interesting. He does it about twice a year to the Federal Reserve, of course, and many other places, but to the Federal Reserve. He's the co-founder of Disruptive Discoveries Journal. I'll tell you where to get a hold of that when we come back, but there's so many more questions. Where do we go to next is probably the big one for investors, or how do you protect yourself? All of that coming your way on the Money Talks Network. We're talking with Dr. Michael Berry. Just thrilled to have him. What a time to get him, though, in post-election time. He just presented to the Federal Reserve again in September. Love to hear his insights, what it's like. Dr. Berry, can I just ask you sort of one of those personal questions? When you go into that room, what is it like when you're presenting to those people? I mean, in terms of, do you go, are you guys nuts? Or do you go, have you got it yet? I'm just wondering the nature of that conversation.
Well, it's always interesting because it's actually a very large group. It's not only the Federal Reserve, but the FDIC, the COC has representatives, controller of the currency, and they're all there. And there's pretty good distribution from across the country. So, people are interested in what somebody on the outside thinks because, to use a phrase, they basically drink their own bathwater internally. Yeah. And the kinds of things that they've been doing, obviously, for 8 years, since 2000, have not worked to get the economy going. President-elect Trump has promised to get the economy going. That remains to be seen. We talked about interest rates. Mortgage rates are going up, and that affects the housing market. So there's a lot of pros and cons here that we don't know about. What Janet Yellen is now saying at the Fed is that we are going to raise rates, and we are worried about inflation that may be generated, and so we will be the counterpoint to the Trump administration. And I don't know how that will turn out, frankly. It'll be interesting to see. I was asked in the presentation, toward the end of the presentation, which I sent you a copy of that, what's going to happen? And I said, the two candidates are not discussing economic issues, and they didn't. They didn't discuss economic issues at all. They discussed each other. And so now the surprise is in. We'll see if this president-elect can govern. And that's a question mark.
Well, it inevitably leads to disappointment because they oversimplify, and it doesn't matter. We had the same thing in Canadians' federal election a year ago. They oversimplify. They pretend it's that simple as Mr. Trump just did. We'll get economies going. When Senator Clinton, Secretary Clinton was senator in New York, she made this big job promise that didn't manifest because it's just not that easy. And one of the things that's interesting is where they think they're going from here, because more of the same isn't going to cut it. As you said earlier, they're probably thrilled that Mr. Trump's got a different approach, at least at this point.
We are. I mean, I think we're all shocked. I think, now in hindsight is so wonderful. Everybody said, well, it was obvious that Mrs. Clinton didn't have what it took, but it wasn't obvious at the time. And it wasn't obvious until 10 o'clock November the 8th, on the Eastern Coast. So now we have this notion that we're going to bring jobs back, but the job market has changed. So this is a much more complex situation. It's also clear that the Federal Reserve, with its current line of thinking, is out of bullets. So, all they can do now is basically raise rates to try and avoid the inflation that's likely coming. We do see now a recovery. The Trump administration is going to spend somehow, and that will have an impact on the economy, I think.
What do you tell individual investors, people who come up to you and say, what about me? I mean, do we have to wait a little bit to see how this plays out? Because there's so many questions at this point. I can tell you in Canada, they're talking an awful lot about a softwood lumber deal, awful lot about NAFTA and any changes there. You know, so there's a list everywhere of what's really going to happen. Does that just tell you as an investor sort of to step back for a little bit?
No, I don't think so. I mean, that's sort of, I know people feel that way. My sense is you have to be diversified. You absolutely must be diversified. So that means that if you're 90% stocked, because the stock market has been boiling now for the last 6 or 7 years, relative, at least in this country it has, you need now to be thinking about allocating to different sectors of the economy, and that's the safest. That's now the safest way. I think the stock market here in the U.S. is due for a dramatic correction. It's just really, really significantly overvalued, and I've said that for quite a long time. So I think diversification, and again, you need to have precious metals because they're cheap. They're as cheap probably as they're going to get for a while, and we've seen a huge move down in gold and a huge move up in the dollar and a huge move down in the bond market. Very big knee-jerk reactions, and they will revert to the mean over time. So I think it's very important to have diversification in your portfolio. Everybody should go to the financial planner and insist on a re-examination of the portfolio relative to assets that are not now in the portfolio.
I think that's great advice, by the way. I mean, look how fast things are changing. I was just saying to my wife last night, I said, think of all that's happened in this past year. I mean, the list is just, a huge one. The latest being Mr. Trump's victory, changing things. And, you need that constant review. And there's been a game change going on in the U.S., and that'll have implications certainly for Canadian markets. But, currencies overseas, the list is really a long one. And I think that's just great advice. It's time to sort of rethink stuff and reapproach it.
Agreed. Absolutely, Mike.
Well, as I say, let's leave with one last thought. We've got the U.S. economy, at least part of it, showing some strength there. We see the rising rates. Do you have a forecast yet for what you see economically in the next year?
I think we'll begin to see a higher growth rate simply based on the new administration. But remember, the new administration will try and hit the road running, but I think sort of by the middle of the year, by the time I present to the Fed in the fall, I think we'll see growth rates probably at 3.5%, just based upon the fact that there is a change coming, that they will spend and they will make some real changes in the structure of the economy. They'll try and bring cash back from overseas from U.S. companies that have it overseas. They're going to probably do a tax effect. Remember that both the House and the Senate are Republican. So a lot will happen in the next 2 years, will have to happen in the next 2 years if this administration is successful.
Well, Dr. Berry, thank you once again. We just so appreciate your insights and the time you take to share with our audience. Much appreciated. And have a happy Thanksgiving.
Thank you, Mike. My pleasure always.
I'll take a break. I'll come back. I got a shocking stat. You want to listen to this one, plus Ozzy and Victor on deck. Just a reminder, you can go to www.moneytalks.net. Lots of great articles up there this week, including on interest rates, so have a look at that. Most popular stuff happening. Also, you can get all information on the World Outlook Conference, and I was just looking over some of the things we did last year at the Outlook Conference. I mean, think about that. It was at the end of January last year, we had Martin Armstrong saying, the Brexit vote is going through. They're just going to vote to get out. That's it. The European experiment is a complete failure. On Trump, he said he's not a fluke. He's not going away, and he'll win the Republican nomination. On debt, I would move out of government bonds altogether and get into AAA corporates. So that's just one example. We got Mark Leavitt. He'll be joining us there. I think of some of the stock recommendations he made last year. Freeport McMoran, 3D printing, Triple D. Las Vegas Sands, Wynn Casinos. My goodness gracious, he had a good year on that. Joseph Schachter's been our guiding light when it comes to what's going on in the oil market, and boy, has he ever been right on for so many years, including the initial drop from 103, 107 down into the low 30s, into the high 20s. And Ryan Irvine's got his small cap portfolio that continues to outshine anything else in the business. So all of that, you can just go with the VIP tickets due end next Saturday. You want to get a hold of those. And again, just go to moneytalks.net. Time now for this week's shocking stat of the week. This is an interesting one because one of the most controversial issues of the campaign was Donald Trump's promise to deport illegal aliens. He specifically has singled out deporting any with criminal records or who are in the country illegally. ABC News reported this early in the campaign, and I quote, Trump said, "On day one, I'm going to begin swiftly removing criminal illegal immigrants from this country," end of quote. He said he wouldn't focus on the 11 million undocumented residents who've lived in the country for a long time without any problems with the law, but he is going after the criminals who are illegally in that country. Now, he'll now get a chance as president to give details of what he's talking about, but here's the part that received no play whatsoever in Canada. And it leads to my shocking stat. His statement closely resembles President Obama's policy of deporting illegal immigrants who have committed a crime. My bet is you didn't know that President Barack Obama has been referred to as the deporter-in-chief by some immigrant groups. I bet you didn't know that according to government data, the Obama administration has deported more people than any other president's administration in history. That's kind of interesting given the outcry about Mr. Trump. ABC News gives us the number. Between 2009 2015, his administration removed more than 2.5 million people through immigration orders, and that doesn't include this year. In fact, during Mr. Obama's administration, he deported more than the sum of all the presidents of the 20th century combined. It's just interesting to see that data. And as I say, 2.5 million. Mr. Trump is talking about that number or more, up to $3 million. But it's those who have entered the country illegally who have committed a criminal act are on the radar. But my point here is it's nothing new. That's what the Obama administration was up to, too. I got to take a break. I got to come back. Hey, I got Ozzie Jurek here. There's been more suggestions of changes when it comes to mortgages. We've seen the interest rate thing go through. We know what happened in October. You'll get the latest from Ozzie when we come back. Plus, Victor Adair is live from the trading desk. There's been a lot of action there. I look forward to hearing what Victor's doing with it. All of that coming your way. And a Goofy on the Money Talks Network. Coming up, I got Victor Adair joining me live from his trading desk. Also, I've got a Goofy award, but right now I got to bring in Ozzie Jurek. You know, if we haven't been dealing with enough, Ozzie, over the last month or so, with the changes in mortgage regulations, we've had other things happening. But now I hear, listening to the CMHC CEO, that's easy for me to throw that many letters at you, the Canadian Mortgage and Housing Corporation CEO, Evan Sindall. I mean, boy, I thought that was qualified as a bombshell this week.
Yeah, no question about it. I mean, first of all, you and I talked about it when the mortgage rates came in. I called it that the government gave an early Christmas present to the 6 banks. They can raise the rates sort of nilly-willy, and they sure as heck did. Last week, the TD raised its variable rates. This week, RBC and TD raised some of its fixed rates, and some of those rates are now almost a third of the percent higher already. And then Evan Sindall says interest rates are too low. Of course, I don't necessarily disagree with it, but then he follows it up by saying the regulators should increase the minimum down payment, saying that low down payments are the problems. Then he says we should impose more mortgage qualifying restrictions, and we should kill all provincial programs that help first-time buyers, and then bring a loan-to-income cap that would limit the size of a mortgage buyers could get qualified by qualifying on their income. Wow, huge changes that he's proposing.
Well, I'm just thinking, how popular would it be? Think about how contrary that is to the sort of general discussion going on right now, where there's been protests, there's been all sorts of talk about first-time buyers having difficulty coming into the market. I mean, didn't Ontario just say it's going to double the land transfer tax exemption for first-time buyers? I mean, that to say we need to kill all provincial programs, for first-time buyers, it seems certainly there's going to be a big rip-roaring discussion over that one.
Well, it exactly. In fact, all of the government measures have been anti-first-time buyer, anti-affordability, yet the official position is we're doing it to increase affordability. Now, he's almost putting stuff on the table that it makes it almost impossible to qualify, but he's also in a big fight that he wants to do with the banks because he wants to share the risk of insurance. Now, bringing sort of a mortgage insurance now deductible for the banks is his idea, and government-backed insurance when a loan falls to a certain threshold, like after a certain number of years perhaps. Canada should experiment with a shared responsibility mortgage where the borrower's payments go up and down with the prices in a given area, and then charge higher premiums that have historically had higher defaults like Eastern Canada and the North. I mean, these are bombastic statements, and I'm just thinking, what does it mean? Because he says if rates go up 2.4% in the next 2 years, which when we can go up a third of 1% in a couple of weeks, that would cause a 30% drop in house prices and would lead to the failure of domestic financial institutions. I mean, he's really putting on the table some sort of a dramatic, you could call it fear-mongering, but it probably is more likely he expects rates to be a lot higher, and he's scared.
Well, I mean, that's certainly going to be headline-grabbing when somebody from a Canadian government institution like the Canadian Mortgage and Housing Corp starts saying that, if interest rates go up like that, there's a 30% drop in house prices. I mean, my goodness gracious. But as you say, there's a lot going on sort of underneath here. The demand that, maybe banks take on more of the mortgage insurance risk, I think, is a very, very good point you're making, because that could be underlying a lot of this talk at this point.
Well, that's it. So obviously they don't, these are big bosses, are big institutions, and don't make these statements without thinking. And by the way, he made that statement in London at a private talk to a highfalutin banking group. So, but they did put it on their website afterwards. So anyways, banks that have to share a premium, Mike, would have to charge for that. So there'd be higher rates. First-time buyers that are less in the marketplace, well, that would also affect a second-time buyer and a third-time buyer. So the market could stall onto this if it happened. And when you look already in the United States, the 30-year mortgage rose from 3.52% to 3.94% in a week. It's now at the highest it's been all year. So this bond market collapse that you talked about with Mike earlier has had an impact, because what people don't realize is that our variable rates are tied to the prime, but our fixed rates are tied to the bond market. And the bond market goes higher, and it's more costly to borrow there, and then you and I have to pay more for mortgages.
Well, let me ask you this. What do you do? You talked about earlier with us, over the last couple of months, you don't know so much about interest rates, but you may have trouble getting a mortgage altogether, and I think that prediction has absolutely come true.
Mike, that is the most worrisome aspect. You might have, you're a young, aggressive family, or you have a rental property, or two even, but you bought them under the then prevailing rules. Now the renewal comes up and the bank says, sorry, you no longer qualify. That is now not just possible, it's probably likely. So I would go sit down with my mortgage broker or my bank, whoever I prefer, and I'd say, look, what would I have to do to go long on the mortgage, or at least for the time or period that I want to keep those properties? It's more important to make sure that money is available to you than worry about another tenth of 1% or quarter of a 1% interest rate, because if they do go 1 or 2% higher and you don't get the mortgage, you're going to be in trouble.
Well, let me just finish with this. Is there even such a thing as a hot property in this environment?
Well, we always find some. We kind of always like Pemberton. We found a Pemberton condo for $228,000 and a solid 2-story home with a very nice view, a large flat lot and fully fenced 3-bedroom double garage for $298,000. Hey, and Pemberton is paradise.
And there you go. For those who are not living in British Columbia, Pemberton is just about 20 minutes from Whistler. And Whistler just announced that their ski season starts on Wednesday, a day early. So that'll be
1 day early, yeah.
Yeah, 1 day early. That'll be an added attraction. Ozzy, go out and have a terrific weekend, because I know your ski season's about to start too.
Yeah, it is. And Mike, when I ski like a young god down the mountain, nobody that I know knows it. But when I lay underneath the lift with a pole sticking out of my ear, people I haven't seen in 20 years say, Ozzy, how you doing?
Well, they love to know that some things don't change. Ozzy, go out and have a great weekend.
You too. Thank you, Mike.
I got Victor Adair. He's live from the trading desk, and I got a goofy award for you. This one is peak. You see things go to extremes. This is, to me, my mind, and you may disagree, but absolutely absurd, and it's actually worrisome when you look closer on it. We'll do that when we come back right here on the Money Talks Network. Got a goofy award coming up, but right now I'm very happy to go live to the trading desk. I've got Victor Adair with me. Victor, I'm looking at, I heard Dr. Mike Berry talk about it, but we see all this evidence, strong U.S. dollars, further in the making. Again, we saw the dollar index explode higher here. I see no reason. You've been talking about this for 5 years. That's a Money Talks top recommendation. And, man, I see no reason to suspect that trend's over.
It depends on your timing, Mike. You know, we've had the U.S. dollar rally for 10 consecutive days. The Chinese yuan on the other side of the world is at an 8-year low here, the U.S. dollar index, and there are various indices, but one of the ones we follow at 13, 14-year highs. You know, and tied to that, of course, we've had this surge in interest rates with American interest rates going up faster than countries, other countries around the world, and that's certainly a boost to the U.S. dollar. But in the back of my mind has been this, I'm going to say there's obviously been a big change with the election. And investors are making assumptions about what's going to happen in the markets going forward. And I'm kind of reminded of two books. One is Thinking Fast and Thinking Slow by Daniel Kahneman. And basically he's saying when you make a fast decision, it's often wrong, that you're better off to think things through. And Howard Marks, of course, in his book talks about first level and second level thinking. I guess just my gut instinct as a trader here is we've had this terrific move across markets since the election, and I'm either one of two things. I'm a little sour grapes because I haven't caught it, because we basically got really flat ahead of the election because we didn't know how to handicap it, or I'm thinking that this huge move is maybe overdone and markets are making a wrong decision about all the things that are going to happen when there's a Trump presidency and the Republicans are in charge of both houses of Congress.
Yeah, well, and certainly they're speculating on what's going to be the outcome when there's all these questions hanging in the air. But I like your point right off the top, Vic, when you said it depends on what your time frame is. I mean, your opinions have to match your time frame. So if you're a trader, as you said, you got to be a little bit leery that profit taking at the very least is going to come through, if not some disappointment, to bring these, U.S. dollar or Dow Jones at another all-time high kind of thing. But if you're longer term, I'm talking now U.S. dollar, there still is a case to be made. I mean, to me, it's meeting our money talks scenarios beautifully. I look at what the euro did this week, and some of that money's coming into the U.S. So I think your point about make your trades or your investments match your time frame is a real key in this environment.
Yeah, that certainly has been one of our key things. I call it, keep the time frame of your trading in sync with the time frame of your analysis, or the other way around. And when I'm talking here in the show, I'm mostly talking about the short-term trading that Drew and I do. We reduced our positions ahead of the election. We'd had good profits. We didn't think we had any skill at handicapping the election. We didn't want to give a good chunk of those profits back because of something we had no idea or any skill to predict. And then we had this dramatic move following the election, and we were basically unable to bring ourselves to jump on it and kind of go with it. We did do a couple of things. The gold market, we bought puts on that just after the election. We covered those puts when gold was down about $50. The gold market, by the way, huge ETF sales this past week, and there's still a great big long position in the spec on COMEX. So the gold market certainly still looks vulnerable, and especially with U.S. dollars so strong, interest rates rising, those are two tough things for the precious metals to try to rally in. And, of course, as Mike Berry was saying here, the Federal Reserve, I think the chances of them raising interest rates by 0.25% next month is about 100%. That's what the market's discounting right now. And the real key, I think, and this is Drew's idea, and I think it's perfect, is the market is not placing much of a bet on the Fed continuing to raise interest rates as we go into 17. And if the market begins to think that will really be another key support for the U.S. dollar.
Well, so much coming on right now. We'll be here to chronicle it. Vic, thanks very much for taking the time. It's been another busy week for you, I'm sure, and we'll be live next week. Thanks, Victor.
Thanks, Mike.
Thanks to Victor. Thanks to all my guests. And a reminder that Money Talks is brought to you by Solera Club. Solera Club is a royalty-based investment. You get paid first. There are no fees attached, and it's in the technology sector. So for more information, go to soleraclub.com. Time now for this week's Goofy Award. One of the takeaways from the U.S. election is that for all the talk of diversity, there certainly isn't very much tolerance of alternative ideas. The case in point, and I think it's a frightening one, is on university campuses. When universities announce things like diversity hiring plans, as Ivy League schools like Yale and Brown had earlier this year, they're not talking about diversity in terms of worldview or political leanings. They're talking about a continuation of groupthink with a prescribed point of view, but with more people of different ethnic backgrounds or sexual orientation. According to the Higher Education Research Institute, only 12% of university faculty identify as politically right of center. And those, the majority, are in engineering professional disciplines. Only 5% of professors in humanities and social science departments identify as right of center. That is not good for education, not good for society, and not good for democracy. So maybe, though, the overreaction on campuses to a Trump victory is not a big surprise. I mean, lots of stories about professors ranting, changing their course titles to something like How Satan Became President and the like. But the over-the-top goofy reaction was the creation of more safe spaces. Now, this is thanks to Glenn Harlan Reynolds, who reported this in the USA Today. The University of Michigan Law School announced, in quotes, a post-election self-care with food and play. Listen to this, in quotes, coloring sheets, Play-Doh, positive card making, Legos, and bubbles with your fellow law students. And they were serious. Sanford emailed its students and faculty that psychological counseling was available for those experiencing, quotes, uncertainty, anger, anxiety, or fear following the election. University of Pennsylvania, that's Donald Trump's alma mater, created a post-election safe space with puppies and coloring books. Seriously. At Cornell, students had a cry-in. At Tufts, the university offered arts and crafts. University of Kansas reminded students that there were plenty of therapy blogs available. I mean, the list just goes on. I mean, this is not only laughable. I find that response scary, not only further marginalizing anyone who might support Mr. Trump, but it begs the question, what are we producing here? Probably generational problems, but I don't get it. My thanks again to Glenn Harlan Reynolds for bringing that to our attention in USA